Today is part 4, Action Without Panic, a calm 2026 adjustment plan. In the last episode, we talked about the mindset of the waiting room. Today, we move from mindset to action, not aggressive action, not a reactive action, but calm, structured adjustments, the kind that protect long-term strategy while markets wait for confirmation. Right now, the Federal Reserve is not reversing direction. It is simply delaying urgency. This is not a crisis environment. It's a plateau environment. And in years like this, the goal is not to predict the exact timing of the first rate cut. The goal is to strengthen your financial structure so you don't feel forced to react when headlines change.
Let's start with liquidity and fixed income, because this is where stability begins. In a year where rates stay higher for longer, liquidity is not a drag, it's a stabilizer. The first adjustment is not tactical, it's diagnostic. Ask yourself one simple question. If nothing changes for the next 6 to 12 months, am I financially comfortable? That means having enough liquid reserves to cover living expenses without forcing asset sales. This is not about maximizing returns on cash. It's about removing pressure from the rest of the portfolio. On the bond side, the objective is also structural. You are not trying to time the exact moment rates fall. You are using today's yields to lock in balance. Think in terms of duration discipline rather than speculation. A simple laddered approach reduces reinvestment risk and emotional decision-making. The key idea here is simple. Liquidity and bonds exist to absorb uncertainty, not to generate excitement. When that layer is stable, everything else becomes easier to manage. The second adjustment area is equities. This is where many investors make mistakes during waiting periods. When action is delayed, the temptation is to either do nothing at all, or to do too much. Neither extreme is helpful. This is not the time to abandon long-term growth exposure, but it is the time to review concentration. Ask yourself, which positions have grown larger simply because momentum carried them there? Trimming winners is not a bearish statement. It's a structural one. Concentration risk often feels invisible during strong performance phases. It only becomes obvious during volatility. This is especially relevant in areas where narrative strength is high. Innovation themes are not the problem. Overexposure is. Rotation, when it happens, is usually a process, not an event. That means observation first, adjustments second, and patience always. You are not trying to predict the exact moment leadership changes. You are ensuring that no single outcome dominates your financial future. Hey everyone, and welcome back. Today we're talking about something crucial for any investor: how to handle those flat, sideways markets without losing your mind or your money. It's easy to feel like you need to be constantly doing something, but sometimes the smartest move is to do less. Let's dive into the 3 key adjustments you can make to not just survive, but thrive during these plateau periods. First, let's reframe our thinking. This isn't a year for chasing quick wins or reacting to every headline. Instead, it's a year to strengthen your foundation. Think of it like a builder reinforcing a house before a storm. Your financial house is your investment structure. Is it solid? Is it built for the long haul? If you've been putting off rebalancing or diversifying, now is the perfect time to focus on that structural integrity rather than trying to predict the next small market tremor. A strong structure provides clarity when the market itself offers none. The second adjustment is about your exposure. When the market isn't giving you clear upward signals, it's wise to manage risk calmly and deliberately. This means looking at your portfolio and trimming any positions that have grown too large, potentially creating concentration risk. Take some of those profits off the table and reallocate them to more stable core holdings. This isn't about market timing. It's about risk management. Locking in some stability now protects your long-term plan from unexpected downturns and keeps your emotions in check. It's a proactive step towards resilience, not a reactive trade based on fear. Now for the third and perhaps most important adjustment. This one has nothing to do with your assets. It has everything to do with your behavior. During these long waiting periods, the greatest risk isn't a market dip. It's decision fatigue. We're bombarded with too many headlines, too many conflicting opinions, and we're tempted to make too many micro decisions. The most effective adjustment you can make in a plateau year is to intentionally reduce the number of decisions you allow yourself to make. This means fewer portfolio changes. It means curating your news sources down to just a few trusted ones. It means less checking your account balance. Uncertainty does not demand constant action. In fact, stability often comes from accepting that not every week or month needs to feel productive in a trading sense. A truly strong strategy is measured by its resilience, not by its level of excitement. If your investment structure allows you to stay invested without constant stress, it is doing its job perfectly. So let's summarize the game plan. 1. This is a year to strengthen your structure, not chase fleeting signals. 2. Adjust your exposure calmly. Trim the excess, lock in stability, and avoid overconcentration. And 3, and this is the big one, don't let a few delayed weeks or months undo a long-term plan that you've carefully built over years. Markets move in cycles. That's a given. But your clarity, your peace of mind, that comes from having a solid structure. I'm Jenny. If you value calm, structured thinking around money and mindset, I share new insights every Wednesday and Sunday right here on Jenny Insights Money and Mind. Thank you for spending this time with me today. I'll see you in the next one.